A banking disaster looms. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, the major banks are facing the worst bad loan crisis since the early pandemic days, and what this indicates. And everything that we've been suggesting on the show, that as banks tighten lending standards, they actually create their own problems as consumers face the worst case scenario. We're going to continue and show you how things with the U.S. consumer are far worse than anybody thinks. And we're at a time when we already know the small and mid-sized banks here in the U.S. are largely insolvent, and this is going to be what brings them all down. Plus, is inflation about to make a big surge higher? And will central bankers finally, for the first time in history, look like the monetary heroes they want to be? Not to mention, we also have a sponsor for today's show, Caliber Mining Corporation. You can find them on the TSX under the symbol CXB and on the OTC under the symbol CXBMF. They're an America's focused mid-tier gold producer. They just put out an amazing press release. But with all of our sponsors, we'd love to show you how to trade their stock. I'm going to show you how in the near term we think there's a 24% move to the upside. And for those of you who are technical traders, it's putting in a massive head and shoulders bottom that could send the stock even higher. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's go to Bloomberg, where he picked today's story up with a headline: U.S. producer prices rise by more than forecast on gasoline and food. And this is one of the concerns that we continue to hear from the central bankers, that this is going to look just like the 1970s, where inflation surged higher, then it came way back down like it did now, and then for no reason whatsoever, because despite all of their research and academics they have on staff, they can't figure out why it surged higher again, other than to say is they're concerned that inflation will happen again. And now we're getting some early signs from the producer price index that maybe, just maybe, that's true. The producer price index for final demand advanced 0.5%. That's a bit hot over what you typically see around 0.2 to 0.3 month to month from a month earlier, marking the third straight increase according to the Bureau of Labor Statistics. The cost of gasoline increased 5.4%, and excluding food and energy, the PPI climbed a more modest 0.3%. From a year ago, the overall measure advanced 2.2. Now, we've been making a case on the show here that this increase in crude oil prices would feed back into producer prices and consumer prices. The only question is how much would we see, or are we going to actually find out that there's perhaps a lot more disinflation in other parts of the data series where we don't see such a big impact in energy? Let's take a look at this next chart here, where we've got producer price index final demand, that's shown in blue, against crude oil prices. That's West Texas Intermediate, both shown on a year-over-year rate of change. Of course, we know the energy, big component of the producer price index. Here you can see in red. This was our concern going into this week, because we have the producer price index today, the consumer price index tomorrow. And what we're seeing here is that big surge in energy is not feeding back all the way into the major PPI final demand data series, suggesting, as we're now know, that there's disinflation in other parts. The prices of goods rose firmly on the back of energy and the strongest advance in food costs. So there's the double whammy in nearly a year. However, excluding those components, they edged up 0.1%, so that's not very much. So we're seeing, again, disinflation in other parts of the PPI as services cost increased by 0.3%, led by financial services. Of course, we know a lot of people are running down to the bank and parking their money, and that is actually feeding back into the PPI here. So let's take a little deeper, because a pickup in oil prices, which reached the highest level in over a year in September, is now threatening months of progress in taming producer inflation. And while crude prices have subsided in recent weeks amid demand concerns, the conflict in Israel risks keeping costs elevated. Now, of course, we will get tomorrow, we get the crude oil inventory report from the government, and we're going to be very interested in this. You may remember last week we saw 6 million barrel in gasoline inventories. If we continue to see gasoline inventories, it's adding to our broad view that the U.S. consumer is tapped out. And wait till we get kind of later here in the story, because I'm going to show you the U.S. consumer is in dire straits, facing a worst case scenario. And then for the banks, well, it's bad news as well. When you strip out food and energy and trade services, which is less volatile PPI measure, prices rose a mere 0.2% for a month, still maybe a little hotter than policymakers would like. Fed officials have been alluding to another pause at their next meeting as a recent surge in bond yields may substitute for additional interest rate hikes, while still stressing that borrowing costs will stay elevated for some time. Of course, that's what the Fed does. They always talk things up. And then, of course, we know throughout history, they're about to reverse direction again when we see the U.S. consumer hit the wall that is coming. The central bank will also see the latest consumer price index, that out tomorrow before its meeting that concludes November 1st. And here we can see that when we look at the producer price index by final demand in blue against the consumer price index, this in red, showed on a year-over-year rate of change. What we can infer from today's increase in producer price index is that the CPI is likely to go up a little bit tomorrow. That would be the base case. If it actually is worse, if we actually see it flatline out or start to come down on a month over month, that's telling us there's a lot more disinflation in the other parts of the CPI when you strip out food and energy. But don't worry, the policymakers have changed the goalposts, but we're looking to say that perhaps some of this food inflation is indeed coming down. As world food prices steady at 2-year low, that on cheaper oilseeds alone. A gauge in food commodity costs was little changed in September, the United Nations Food and Agricultural Organization just said on Friday. The slump from a record set in March of 2022 should eventually help ease grocery inflation that has been rampant since Russia's invasion of Ukraine, and there are signs of that already happening in some countries. Now, many of you are saying, well, wait a minute, I'm not seeing lower food prices. Well, there's a reason, but it's coming. It takes a while for lower food commodity prices to filter through to supermarkets, which have been contending with higher energy and labor expenses. Retail food prices in Britain fell for the first time in more than 2 years in September, though costs have continued to climb in nations from Turkey to Kenya. So what this suggests is we look forward in the months to come and we start trying to predict where the CPI is headed. If we do indeed see crude oil prices roll over and head lower. Now, I know many of you are concerned that what's going on in Israel will send oil prices higher. We can look in the past and say there is a transitory move up, and then next thing you know, it's all about demand. So that's why we're focused on the Thursday EIA report tomorrow, but notably what we can now see from this food report on oilseeds, that as it filters into the grocery store over the next couple months, that food inflation is indeed coming down. But as I mentioned, the Fed keeps changing the goalpost, and does today's PPI report have any help with that? As U.S. core inflation seen corroborating higher for longer Fed, of course, that's all they want you to believe, is they know what they're doing and they're going to keep rates higher. We continue to make the case the Fed is going to go to zero faster than they've ever been in history. As the consumer price index excluding food and fuel, a measure favored by economists as a better indicator of underlying price pressure, is seen increasing for 0.3% for a second month, and that's really higher than what we want to see. And on an annual basis, the core CPI is projected to cool, but that's a reflection of the base effects. Looking back to September of last year, it rose the most since 1982. And when we take a look at the producer price index here again, final demand shown in blue against the core CPI, this is less food and energy in red. What you can see is there's really not much of a relationship here, so we can't really infer anything from today's move and report on the PPI of where the core CPI is going, but we can kind of get a hint because it moves so slowly that it is likely to continue to trend lower. That would be our expectation. The headline number we think goes up, the core we continue to see cool off, but that's not what the important part is here, is because it's not what's happening today, it's what's coming over the next few months, and that is the U.S. consumer is about to hit a wall in the big way. And we talk about the banks. Now remember, this is all comes back to the banking system, because as long as the banks are originating enough new loans, what that means is we have money created for growth, but to pay on the existing debt. So when we see the Federal Reserve start to invert the yield curves, the banks start curtailing their lending, what is our next expectation here? If we should start to see an increase in delinquencies, we should start seeing an increase in bankruptcies, even defaults. These things should start to pop up. And when you start to get them in the consumer space, this is a real problem, because when consumers run out of money, they do two things. They cut their spending and increase their savings. And that's not what we need, because I'm about to show you we're going to hit a wall. As the New York Fed survey finds a surge in household delinquency expectations, the worst, get this, worst since April 2020 COVID crash. So again, you're talking about the worst data series since the worst part of the pandemic, as now consumers are looking and saying, I have no idea how I'm going to be making these payments, and that means I'm headed into delinquencies. When you start to look at the banks, when people go into delinquencies, the banks have to put more money in reserve. It means lend less at a time they're already lending less. Of course, there's another factor here. When banks put money in reserves, they buy bonds. And if they do that, well, guess where interest rates are headed? But while the latest uptick in income growth expectations was welcome, what was more troubling was a response to the question whether a respondent won't be able to make minimum debt payments over the next 3 months. So I want you to be thinking, what's coming over the next 3 months? The holiday season. This is a time when people usually spend big. They go out and they charge, and then they pay it later in the early part of next year. And now we're already seeing signs that they're not going to be able to make their minimum payment. So what does that mean for holiday spending, which we've been making the case, is it's going to be a dud. As shown below, the expectations for debt delinquency surged to whopping 12.5%, the highest since the COVID lockdown in April 2020. We'll show you that chart in a moment. The increase was the largest for respondents below the age of 40 with some college education and those with an annual household income below $50,000. So we're already starting to see pressure at the lower incomes now, and this is a problem because as they run out of money, and we know that these income groups typically spend everything they make and often then some, so if they're forced to curtail their spending, well, now all of a sudden it's going to flow into higher incomes as you see less discretionary spending, less overall spending impact the economy. As we look at debt delinquency expectations, we now see unable to make their minimum debt payment over the next 3 months. Here it is, the highest since the pandemic, and that trend is not good. This is rising, and as we've made the case, likely to continue even higher in the months to come. As perceptions of credit access compared to a year ago deteriorated slightly. That's an understatement because consumers haven't figured out that they can't access the credit they need. The banks are going to continue to tighten up and continue to limit credit access to consumers, which is only going to put them further into delinquency. The share of households reporting that it's more difficult to obtain credit now than a year ago increased, while the share reporting that it got easier declined. Similarly, respondents' views about future credit availability deteriorated slightly, and it's going to deteriorate a whole lot more. The share of respondents expecting tighter credit conditions a year from now increased, while the share expecting looser credit conditions declined. Meanwhile, median household spending growth expectations remain unchanged at 5.3% in September, above pre-pandemic levels. We're going to make the continued case that as money dries up and credit dries up, that all of a sudden consumers are going to cut their spending in a big way. They're about to hit a massive wall, particularly as we start to face the reality of how the economy is going to grip with return of these student loan payments. Now, what does this all mean for the big U.S. banks? Well, it's not a good sign. It puts them in a worst case scenario because this all is going to feed back to those small and mid-sized banks that we know already today are insolvent. As the largest U.S. banks grapple with the worst write-offs in 3 years, JP Morgan Chase, Citigroup, and Wells Fargo, which report third quarter results on Friday, will join Bank of America, which comes Tuesday, in posting roughly $5.3 billion in combined third quarter net charge-offs, the highest for the group since second quarter of 2020. So what this is suggesting is they know people aren't going to pay their bills and they're taking them as losses. These are not a good sign for the big banks because it only starts to give us a picture of what's coming for these small and mid-sized regional banks that we know are sitting on massive amounts of upside down commercial real estate. It's the only question is, when do people start handing the keys back to these banks and we see them start to hemorrhage at a time when they can't afford it at all? The figure is more than twice as high as a year earlier as lenders contend with consumers struggling to keep up with rising interest rates and a commercial real estate industry that's still grappling with fallout from the pandemic. Of course, nobody can see the fact that the banks aren't creating enough new money. At the same time, they're not extending credit because we know that consumers, when they're behind, want to borrow more. The problem is when banks don't give them enough limit or they block them from having more credit access, they end up going into delinquency. This happens literally every cycle. Here we see from the Citigroup Chief Executive Officer Jane Fraser said last month that her bank is starting to see signs of weakness in U.S. consumers with low credit scores. Well, there's a surprise, who have had their savings eaten away by historic levels of inflation, and still, she said, the vast majority have been able to handle the rate increases. We know that that isn't going to last much longer because due to their most recent Fed report on the state of pandemic savings, it should be gone or almost entirely gone now, only leaving us to wonder what happens to these other income groups as slowly those on the bottom run out of money and it feeds higher into the mid-tier and high-income earners. We're seeing credit quality suggest banks may have to set aside more money to cover their sour loans should the economy deteriorate. Higher provisions to cover bad debt would eat into their earnings. Now, this is something that a lot of people don't understand about the banks. When they actually believe that they're going to see loans go bad, they have to put more money in reserve. And when they do that, they actually go out and they buy bonds, which is interesting because it starts to drive rates down. But at the same time banks put more money in reserve, guess what that means they're not doing? If you said they're not lending as much, you got it. So what you start to create is a negative feedback loop inside the banking system based on the fact that the Fed inverted the yield curve, tightened credit conditions, and yet didn't realize what they were doing. The banks in turn curtailed credit growth, and then as a result, because the economy slows and there's too much debt and interest rates have gone up, consumers can't pay on their debt, putting the banks in a situation to buy more bonds and lend less. Again, now you can see that big negative feedback loop. And is the Fed done? Well, according to them, no. As higher rates may be needed to curb inflation, this according to Fed's Bowman. As we look at these headlines, the Fed governor says spending still strong, the labor market's still tight, and warns higher rates may pose financial stability risk. That is an understatement of the century. Is yes, the Fed is going to create massive financial instability. They're going to create another financial crisis. They always do. And now here we hear back from Fed's Daily, says neutral interest rate. That's where they kind of think the rates should be to keep the economy growing at a steady pace, could be higher than during the pre-pandemic, suggesting the rise in bond yields may substitute for a hike. And yet the chief speaks at a town hall event here in Chicago, suggesting, as we know, that they have no idea how the monetary system works at all. They think they're going to raise rates a little bit more maybe and then bring them down and find a neutral rate. We're saying they're going to be at zero faster than they've ever been. But one thing we think is going to be a big hero, that's our sponsor for today's show, Caliber Mining Corporation. Let's take a look at them. You can find them on the TSX under the symbol CXB and on the OTC under the symbol CXBMF. I'm going to show you this incredible chart setup. Near term potential move 24%, move out of this inverse head and shoulder pattern, and it's going to the moon. Now we got all the information in the pinned comment and description below. Let's take a look here, because they're building a growth-oriented, Americas-focused mid-tier gold producer. That's what they are. They're a multi-asset producer with excellent near mine discovery and organic growth potential. They're focused on building long-term sustainable value for their shareholders and communities they operate in and all stakeholders. They've got mines in Nevada and Nicaragua. And if you want to stay in touch with them, now they reached out to me and said, look, Steve, it's real important. If any of your viewers want to know what we're up to, please tell them, sign up for our email list. So here you can do it. It's on their website. Go over to the contact page, select the subscribe, put your name, put your email, and they will keep you up to date on everything that's going on with them. But we're going to talk about their chart at this point and the opportunity that we see in their stock. And if you're looking at this, you're saying, Steve, wait, I see a left shoulder, a head, and a right shoulder, and you say, wait a minute, that looks like an inverse head and shoulders pattern with a neckline around $1.30. Well, my friends, you got it. Our initial case is a 24% move up to the neckline, and if that breaks it from there, you're talking a massive move higher under the fact that you're seeing a lot of large accumulation of Caliber stock. And where they are located, they're a Canadian-listed, Americas-focused, growing mid-tier gold producer with a strong pipeline of development and exploration opportunities across Nevada and Washington in the United States and Nicaragua. Caliber is focused on delivering sustainable value for shareholders, local communities, all stakeholders through responsible operations and a disciplined approach to growth. You can find them again on the TSXV under symbol CXB or on the OTC under CXBMF. Now let's take a look at the recent press release, because in the mining space, a lot of these companies, they're not even generating income, they're exploring, but not Caliber. They are bringing in the money. Here we can see their Q3 cash increased to $97 million, a 26% increase over the second quarter, and a 72% increase since the start of 2023. They're on their fourth consecutive record consolidated quarterly gold production. They've got a 50% increase in gold production compared to Q3 of 2022, and their Nicaragua gold production is up as well. And they've got record consolidated year-to-date gold production of over 200,000 ounces. This company, that's why you want to know why their stock's about to break out over that head and shoulders pattern, is because they're making money. Here we zoom in to the 90-day chart, and what do we notice? RSI is getting near overbought territory, but we know the stocks can stay overbought and rally for a while. We see the MACD momentum building here. Here's our base case. Break through this volume profile at 115, and you're up here into the 130s. There's your 24% move to the upside for Caliber Mining. And they're delivering sustainable value for their shareholders. They're delivering on their commitments. They've got a strong financial position, as you just saw. They've got underexplored and prospective land packages, and they're growing their production base here in the Americas. And one thing we think is also going to grow is their stock price. Again, now we zoom into the 30-day. You've got a little volume profile here at 105. You break that, you get through the next volume profile line, and you're up at 24%, looking at that head and shoulders pattern breakout, and that would be a huge opportunity for Caliber. Again, on the TSX under CXB and on the OTC CXBMF. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now. Oh, and by the way, as with all companies featured on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. Bye now.